The cash flow statement is discussed in this video segment. It is analogous to one's personal checkbook or bank account balance in that it determines the amount of cash that the company has in their possession at any particular time. The bottom line of a cash flow statement is the change in the cash balance for a particular time period. When this is added to the starting cash balance, you get the ending cash balance, as we will see. So here is a cash flow statement. And the first thing that's recorded on a cash flow statement is the net income that we did in the previous video. $1,840 becomes cash that adds to your balance of your cash account. The second one is depreciation. You remember back in the previous video we had depreciation $250. But depreciation is not paid to anybody. You pay for the asset up front, and this is just an estimate to get an estimate of net income. But so since it isn't a flow of cash per se, you add it back in, you reverse the charge. So you add that to net income. You might note down below we will take out the cash to pay for assets. That will come later. But right now we're just getting the cash flow from operations. And that is not a cash flow, so it's a positive. The other area, which will confuse this a little bit, is working capital. Working capital is such things as inventory, accounts receivable, that money your customer owes you, accounts payable, money you owe your vendors. It could be wages payable, could be taxes payable, quite a few things. We would generally limit it to this list in this course, generally fewer than this. How does this work? Let's look at it. Say we had inventory, we had a beginning inventory of $1,020. At the end of this period, we took inventory or checked it, and we have 1,008. That means we've had a change of $12, and it has diminished by $12. That's the materials that we purchase. Finished inventory, after you've taken that material and made inventory, finished product you have in the warehouse. We started with 3,280, ended up with 3,330, so it has increased by $50. Our customers from past sales owed us $5,850 at the start of this time period, and now it is $5,968. So there's $118 more that is owed to us by our customers, which could be collected. It's an asset that we could, when it comes in, it will add to our cash. But it went up by $118. Then we have what are called debit accounts. These are money that you owe to other people. Essentially, they are like loans to you. Excuse me. Accounts payable started at $892. That's money we owed to vendors, and increased to $930. We record these as negatives because they are liabilities. They are old versus assets, as these three are. When you subtract that, I-34 minus the previous one, H-34, you get $38. You always take the later one, the ending, minus the beginning. Wages to employees stayed the same, so there's zero change in cash balance. Taxes payable went from 64 down to 60. So 60 minus a minus 64 gives you $4. So the total change in working capital is $122. Now, an increase in working capital is paid out of cash. So in this case, if our finished inventory went from 3,280 to 3,380, it increased by $50. That is paid for, essentially the labor and the materials, and paid out, and so your cash goes down. So what happens when the change in working capital goes up, your cash goes down. You have to pay for this. If accounts payable went up suddenly to 1930, I better put a minus sign in front of that. That's money that you owe to vendors. Then suddenly we would have 878, and that would mean our cash will go up by 878 on the statement over here. But let's change that back to where we were. Our change in working capital went up $122. We had to pay that with cash, so our cash goes down by $122. You reverse the sign when you go from your working capital worksheet to your cash flow statement. It works in reverse. So we can add these three up and we get $1,968, which is our cash flow from the operation side of the business. It's really an adjustment to the net income, which is the operation side of the business. Then we have capital activities. Did we buy any equipment? Yes, we bought something for $4,000, and so that comes out of cash. We did some building improvements, cost us $500. Land, no change. These are our capital assets. And so these two items reduced our cash by $4,500. In our financial activities, we sold stock to outside owners, and that brought in $3,000 in cash. We did not pay any dividends. We issued some bonds, which brought in $100. No change in long-term loans. We made coupon payments on these bonds of $480, not just these bonds, but all our bonds that we have issued, of $480, which reduces cash by that much. The sum of these five is $2,620. We add these three, an increase here, a decrease here, an increase here, we get a net change in cash of $88 for this time period. Our beginning cash in hand was $10,200. We had $88, and our ending cash on hand then is $10,288. So keep in mind there's typically three aspects to a cash flow statement. If you separate it that way, it's easier to figure out where things go and the effect of them. Very important to typically have a separate working capital worksheet. To try to integrate it in there can get very confusing at best. Thank you.